Much for joining, and now I hand it over to Ryan Behrens, our Vice President of Product Development.
Thanks, Julie, and thanks everyone for joining us this morning for a few minutes. My name is Ryan Behrens. As Julie mentioned, I'm an actuary and I lead our product development team at Athene. So I work closely with our marketing team as we bring new product solutions to market, but also on an ongoing basis to generate content that helps people work with our products. And that's what we're going to be talking about today. We're excited to offer a webinar that provides more insight into how our products are constructed. We'll start by covering some fundamental concepts related to pricing and hedging for indexed annuities. And then we will look at how innovation in the index options offered in our products can add value, and how using them in a diversified fashion can be helpful for customers. So the goal of today's presentation is certainly not to bury you in actuarial jargon or obscure mathematical notation, but instead we want to provide some straightforward examples that will help illustrate the key building blocks of indexed annuity products, and kind of offer a look under the hood in terms of how they work from a pricing and risk management standpoint, and then some additional detail on the indices, as I mentioned. So to kick off, the presentation will be split into two components. The first one, as I mentioned, is kind of the introduction to how we price indexed annuities, and the second is about diversification and the lineup of indices that we offer in our products. So getting into the pricing content here, the first thing that I wanted to do at the outset is distinguish between an index and a fund. So an index is a tool that tracks the value of something else. And you can't buy an index in the way that you can buy a mutual fund or an ETF, for example. That line gets blurry in indexed annuities because you're usually talking about equity indices. But it's important to remember that there are lots of types of indices out there. So another common one is the consumer price index, which is how people think about inflation. And what the consumer price index does is measures the value or the price of a number of common household goods. There are financial products tied to the consumer price index, but that doesn't mean people are buying those underlying household goods. They're just buying a financial product that's tied to how that index is changing. So similarly, within an indexed annuity, the policyholder doesn't invest their funds directly in equities. And on top of that, the insurance company actually doesn't buy the equities that make up the index. Instead, we use options, which are financial instruments that have values tied to how the index is moving, to provide exposure to equity performance and to support the interest credits that we've promised to our policyholders. We'll talk about it more later, but options are a risk management tool for the company. That's a really important concept to emphasize. They're not a source of profits. They are used as a risk management tool. So if, as we get premium in the door every day, and and we set up policies, you might be asking, well, if the customer's money doesn't go into equities and the insurance company doesn't buy equities, then what are we doing with all the premium that we get every day? The answer is that our policies are backed primarily by bonds and other fixed income assets. And this slide walks through kind of the key equation underlying indexed annuity pricing using illustrative numbers, and we'll talk about each piece. So when a policy is issued, we purchase assets that match the expected duration of that liability. So, conceptually speaking, we would invest in 10-year bonds to back 10-year products. And we expect to hold those bonds until they mature. So that's why we have things like surrender charges and MVAs in our products, because if policies surrender early and we have to sell those assets to fund surrender benefits, we might have to do it at a loss depending on what interest rates have done since we purchased the assets. So in this example, we're assuming that the yield on the fixed income assets is 5%. Part of this goes towards covering the cost of running the business. So that's things like our expenses, the distribution costs we have in the form of commissions, and a margin for our profit. And we're assuming that's 2% in this example. The remainder is then used to purchase options to hedge index credits, and we call that our option budget, and that's 3% here. So the really important kind of punchline from this slide is, if we get $100 of premium in the door, then only, in this example, only $3 is invested in options. So again, when you think about what's backing the policy, the vast majority of an indexed annuity policy is backed by a high quality, diversified fixed income asset portfolio. So that's we'll keep this equation in mind as we go through the subsequent examples. This spread or yield minus spread equals option budget is a core thing that we'll see through the remainder of the content here. Before I go through some examples of how this works in practice, just wanted to underscore a couple of points. The first one is that we use our option budget to maximize policyholder value in the form of the caps and participation rates we can offer. So if we determine that our option budget is 3%, then we spend the 3%, and that you see that in the rates that are offered in the product. And then the other point is that our profitability isn't dependent on whether the index goes up or down after we've bought options and started accrediting terms. So we make the same amount of money if markets go up or go down. And we'll see this in action in the following slides. But the thing that I want to tie back to the prior slide is that the fixed income asset yield, so the 5% in that example, is really what's driving our profits. It's not the payoffs from the options. The options, again, are simply a risk management tool that are used to make sure that we can honor the index credits that are built into our contracts. So now we'll look at an example of how this works in practice and how this option hedging strategy works. It's all based on buying and selling call options, which are financial instruments that have payout profiles that depend on the performance of the index. And we'll see how that works as we go through here. The first example we have is for a very traditional one-year point-to-point capped strategy. So kind of the fundamental strategy that's been in FIA products as long as they've been around, essentially. So what we do is we start by buying a call option. That's what we refer to as an at-the-money call option. And what this call option does is it provides a positive payoff if the index goes up relative to its starting point, and it provides a zero payoff if the index goes down. So we're illustrating that here with the blue and red lines, assuming the index starts at $100 at the beginning of the term. So what this really means, this call option, what it really means is that we've found a counterparty that's willing to enter into a contract with us to settle that difference at the end of the term based on how the index has performed. And I mention that because it's important to remember that we're not actually buying the equities as the insurance company. We're buying these options, and what these options do is provide a payoff profile that's linked to the way the index performs that we then can use to fund our interest credits. So when you think about this first call option that we've purchased, we have something that has unlimited upside and no downside. So you might ask, why don't we just stop there? That sounds pretty good. Well, in the example, we're assuming that the cost of that option is 8%. And 2 slides ago, we determined that our option budget is 3%. So you can see that if we have 3% available as a budget and we're routinely spending 8%, we can't keep doing that for very long. So there's another piece of the puzzle that's needed to make this sustainable. And that's what the next slide will walk through. So after we purchase the first option, we turn around and we sell a call option that has very similar mechanics. There's just 2 key differences. The first one is that we've sold the option. So now we're on the other side of this transaction. So we potentially owe a payoff to a counterparty if the index has positive performance. And then also the threshold at which this option has a positive payoff is set higher than the first option. It's set at $105, and with the starting index value still being 100. And we call this an out of the money option because the index has to go up to 105 before there will be any payoff. And because that threshold is higher, the cost is lower for this option. So here we assume that this option has a price of 5%, and that's what we receive from our counterparty when we sell it. So when you combine the 8% that we spent on the first option and the 5% that we've received from selling the second option, we now are balancing back to our 3% option budget. So this now works. This can now be sustained in practice. And the next slide goes through it in a really clear fashion. But when you combine these 2 options together, the one that we've bought and the one that we've sold, the maximum net payoff of the 2 is $5, which is what establishes the cap rate for the policyholder. So that's how, based on the pricing of these 2 options and our option budget will determine where we can set the cap rate at any given point in time. So when you think about the payoff profile of these 2 options, what we've done is that we've sold the second option, which caps the upside potential and the amount of payoff that we can get in order to afford the downside protection provided by the first option. And this is very consistent likely with how you talk about indexed annuities with your clients from a customer risk return standpoint, but you see it directly in action in the way that the hedging strategy works as well. So that's those are kind of the key building blocks, the two options to create this this hedging strategy. Here we've got a table that summarizes really nicely the mechanics of these two options. So these are the three possible states of the world at the end of an indexing term. Again, we're assuming the index starts at 100. So the index can either end above 105, it can end between 100 and 105, or it can end below 100. So these are the only three things that can happen. And in any of those cases, what we see, and I'll walk through it in line by line here, but what we see is that the payoff from the options exactly matches what we've promised to the policyholder. So in the top row, if the index ends above 105, the first option gives us a payoff equal to the excess over 100. Say it's at 110, then we get 10 from the first option, but then we turn around and we owe the difference between 110 and 105 to our counterparty for the second option. So again, the net payoff of those two options is capped at 5, which corresponds to the 5% cap that we would declare for the customer. If the index ends between 100 and 105, say it ends at 103, then we get a payoff on the first option of the excess over 100, so that's $3. The second option, though, didn't reach the threshold of 105 where we owe a payoff, so it expires with no payoff. But then that $3 payoff that we got from the first option just goes directly to funding a 3% interest credit for the customer. And then if the index ends below 100, then both options expire with no payoff, and we have a 0% credit to the customer, which again is a fundamental part of the indexed annuity value proposition. So this ties back to a point I made a few slides ago, that the insurance company makes the same amount of money regardless of the way the index performs, because in each of these three states of the world, what we've done is we've spent the 3% option budget at the start of the term. So that's a fixed cost at the start of the term. And then at the end of the term, we get a payoff that exactly matches the index credit. So that, again, it illustrates that point real nicely. And then the last thing that I want to mention on this slide is that the top right-hand box of this chart is really key and probably one of the biggest misconceptions about indexed annuities. If the index outperforms the cap rate significantly, then people might be inclined to think that that means a big windfall and a big, extra profit for the company. But that's not the case, because in buying and selling these options, we've sacrificed our exposure to the index performance above the cap in the same way that the customer has. So again, even if the index goes way above the cap, all we get is $5 from the net payoff of these two options, and that goes towards funding the $5 interest credit. So here on the next slide, we have a similar example, but it's based on illustrating participation rate strategies, which have become increasingly common in indexed annuities in recent years. And it's really the same fundamentals. It's all based on call options to use to create the hedging strategy, but here only one option is involved. So we just buy the initial option, and then the trade-off between downside protection and upside potential comes in the form of a participation rate rather than a cap. So in the left-hand example on the slide here, we're assuming we purchased that same option for 8%, which still is higher than our option budget. And instead of selling a second option and establishing a cap, we scale our option purchase so that we can balance back to our 3% option budget. So the box at the bottom of the slide shows that if we take 3% divided by 8%, then that gives us 37.5%, and that is that dictates where the participation rate is set for the customer. So that's just a different trade-off between downside protection and growth potential. And the other thing that I want to mention here is similar to the example of what happens if the index is above the cap. Here, it's important to note that the insurance company doesn't keep the other 62.5% of positive index performance. We've scaled our option purchases as if we only had 37.5% of the premium that we actually had. And what that means is that when the option pays off, then it gives us exactly what we need to fund index credits, and again, just used as a risk management tool. So there are two graphics on the slide here, and without getting too specific, the reason there are two graphics is to illustrate the difference between a traditional strategy or a traditional index with higher volatility and a volatility controlled index. So volatility is one of the key determinants of option pricing, and generally speaking, higher volatility means higher option costs. So if you have an index that has a lower volatility target via a vol control mechanism, then it may have significantly lower option costs, which is going to impact the participation rates that you can offer. So here, just to illustrate it, we're assuming that the cost of that same at-the-money call option is 2.5% for this volatility controlled index. And we do the same math when comparing it to our 3% option budget. And here we end up with a participation rate of 120%. So, you know, in addition to that first question of what happens when the index outperforms the cap, probably the second most common question about index annuities is how can you have a participation rate higher than 100%? It makes sense that it can be hard to wrap your head around getting more than 100% of something. But the thing that I like to point to there is to remind people that you're not buying the index directly, you're just buying exposure to it. And within this product, you can have exposure greater than 100%, and that's true of other financial products as well. And that's what you're seeing when you see a participation rate in excess of 100%. So the table on the following slide is very similar to the one we looked at in the first example. And the key conclusions are the same, really, that in either state of the world at the end of the term, what the options pay off exactly matches what the index credit is. Here we only have two potential states of the world because there's only one option involved. So the index can either end above 100 or below 100. But in either case, the payoff from that hedging strategy exactly matches the index credits. So to wrap up kind of this first section of the presentation, just a few points that I wanted to mention and to reiterate from what we've covered so far. So the first one is that in offering indexed annuities, the insurance company doesn't invest directly in equities. Instead, we use options to create a risk management strategy that matches the mechanics of our index credits. And I know I probably sound like a broken record at this point, but we make the same amount of money regardless of index performance. So, and on top of that, hitting the cap doesn't mean that the company makes a bunch of extra profit. So when you take a step back and think about everything that we've talked about so far, an indexed annuity is really a pretty cool investment strategy. It's backed by a combination of a diversified fixed income asset portfolio that's run by world-class asset managers. And then it's coupled with these index options that provide equity exposure. So even if you understand these building blocks, it's pretty hard, if not impossible, for an individual investor to go and replicate this investment strategy on their own. And even if they could, it likely wouldn't be cost effective to do it just for their own assets. So doing it at the scale that an insurance company does it is one of the other things that that makes this viable. So based on all of this, you know, just all of this underscores the fact that we feel like these are really great products that provide a lot of value to our customers as they plan for their retirement and their financial security. So now we'll shift gears, and everything we've talked about so far is just kind of general and conceptual, talking about the building blocks for indexed annuities without regard to the specific index options. So in the second half here, we will focus more specifically on the lineup of indices that Athene offers within our products and the power of having a diversified and complementary set of choices that we offer to our customers. I'll start by talking about our philosophy for selecting indices. This is a very disciplined process, and there are several important dimensions that we consider. The first one is the intellectual property behind the index. So this is the key starting point. It's really got to be an idea that we believe in and that we feel is built on sound academic principles. We have a strong track record of success with alternative or custom indices. So we feel like we really do get the opportunity to see the best ideas that are coming through from the banks and asset managers that are building index solutions for the FIA market. The second point is diversification. You'll hear me say that a lot in this section. It ties to the overall theme of the webinar, and we'll explore it in detail in the slides that follow. But really, the key thing here is that we want the options in our products to be complementary. We don't need multiple indices that are designed to perform similarly in similar environments. We want to offer a logical set of choices for our customers in a straightforward framework. The next one is the terms in terms of the kind of the business deal that we have between Athene and the index partners that we work with. So onboarding an index involves a negotiation with the partner that we've decided to work with. And we want to deliver strong volumes to our partners, but we also want the deal to reflect the long-term commitments that we make to our customers. That's a really important element. And as we're negotiating these terms, we work to get the best pricing we can on the options that we're going to buy to hedge our index credits, so that we can maximize the value that goes to our customers in the form of caps and participation rates. And then the last element is dimension that I'll mention is support from our partners. So it's not just about having a strong index, it's also important for our partners to support value add activities that are critical to the sales process. Hopefully some of you have seen information and content that is available from our index partners at HSBC, Bank of America, and BNP. We periodically offer standalone webinars that focus on their individual indices, and they're all great partners and do a lot to contribute to the success of the indices in the field. So next I want to go through a few key points related to the value proposition for alternative or custom indices. We believe strongly in the value of alternative indices, and that's why we put so much energy into incorporating them into our products. And there's really a whole separate presentation on why alternative indices have become so popular within FIAs, but I'll just hit on a few key points here. So one perspective is consumer perspective. So it does a few things. Alternative indices offer more choice. So for a long time in indexed annuities, it used to be that you could have anything you wanted as long as it was the S&P. Now there's just a much wider variety of choices available to customers. Diversification is the second one. By allocating funds to multiple indices that are designed to perform in different environments, this gives customers the chance to increase the possibility of having strong outcomes in varying economic environments. And then the last one is growth potential. So one of the hallmarks of these alternative indices is that they usually also have a volatility control mechanism involved. And what that does is it allows the insurance company to offer uncapped crediting strategies, which can deliver outsized credits versus a point-to-point cap strategy. And we'll see that in some of the analysis that follows. From a carrier perspective, alternative indices do a few things. They offer differentiation via the fact that a lot of these are proprietary solutions that are only available in a single carrier's product. They offer stability and option costs. So by stabilizing the volatility, that stabilizes option costs, which helps facilitate the management of both new business and renewals over time. And then the last one, consistent performance. In addition to being really happy when we see strong outcomes for our policyholders, the company's overall financial performance is helped when account value performance is consistent. So the last kind of qualitative slide that I'll walk through just looks at what our index lineup looks like in our national FIA products. And it's really curated to be complementary with diversification in mind. So as I mentioned previously, there's not a lot of value in offering multiple options that all perform in the same type of economic environments. So we really want these to be complementary. So the lineup, when you look at it here, if you look at it horizontally, we've got traditional options with the S&P 500 and then volatility controlled versions of the S&P 500. And then we've got 3 custom volatility controlled indices that are exclusive to Athene's products. And 2 of them are innovative in how they provide equity exposure, the AI-powered US equity index and the NASDAQ FC index. And then the other one is a multi-asset index with global scope. That's the BNP MAD5 index. And just as we go forward and as you work with our products, really encourage everyone to think about this lineup of indices in aggregate because it is the full set that is most meaningful. So now we'll look at a more quantitative perspective on demonstrating the value of diversification. First slide that we have here shows a graphic that's in one of our marketing pieces on diversification. And what this Callan chart shows is the performance of the 5 indices over the last 15 years within the product. So with the applicable caps and participation rates applied and with interest credits floored at 0%. And this is just looking at the 1-year crediting strategies. So each year, the indices are ranked from highest to lowest in terms of their relative performance, and then we chart that across time. So the key thing that jumps out at looking at this is that there's no index that's a winner every year. So when you think about that over time, it's very hard to predict in advance which index is going to be the best performer. And by diversifying, you can ensure that you have some exposure to the one that's performing the best in various economic environments. So this provides very tangible demonstration that diversification is worthwhile. Another lens that we can look through is looking at the full lineup of crediting strategies, both the 1 year and 2 year, and looking at historically, based on historical index performance, what the probability of a 0% interest credit has been, and what the average return looks like. So when you look at this, the thing to note here is that if you allocate all of your money to a single index strategy, then there can be a fairly meaningful possibility of a 0% credit. And by diversifying, as we'll see in the following slides, you can manage the risk and return profile in a more enhanced fashion. So the exercise that we went through to develop some analysis and some thoughtware on this topic was based on looking at our products in the context of the Efficient Frontier framework. And really the key goal is to illustrate the value that can come with diversification across multiple indices. So just quick background on Efficient Frontier theory. It's based on the academic research of Harry Markowitz. He actually wrote a paper in the 1950s talking about this concept that diversification had the potential to increase expected returns and also decrease risk, but it really didn't gain much traction at that time in terms of how people thought about investing. Then you fast forward several decades, and in 1990, he won a Nobel Prize for this work. So it kind of points to the fact that he was ahead of his time. And now this idea of diversification and efficient frontier theory is really a hallmark of how people think about managing investment portfolios. And Markowitz is often referred to as the father of modern portfolio theory. So the core idea behind efficient frontier theory is that when investing, you should seek the maximum return per unit of risk in how you set up a portfolio. And this concept of optimizing return per unit of risk is really perfect for FIA products because the option budget that we spend to hedge our index credits, the 3% from that earlier example, represents the amount of risk that we can put to work, so to speak, for the policyholder. So what we want to do is put that to work, put that option budget to work as efficiently as possible. A lot of times people think about diversification across assets in a portfolio, but as we'll see here, it can also apply really meaningfully within an FIA product. This will also link back to the power and the appeal of alternative indices that I talked about earlier. And then we'll point at the end to some really good marketing collateral that we have that demonstrates these concepts in action. So the analysis that we performed to develop this was based on taking historical data on the performance of the indices. So this data set goes back to February of 2005. And based on the product rates at the time that we performed the analysis, we created a set of hypothetical portfolios of allocations across the indices, and then calculated the index credits that they would have provided over time. And the goal is really to create as many portfolios as you can think of, so as many possible combinations of different allocation percentages. And so we developed a framework for doing that, and the result was 44,108 hypothetical portfolios. And each one of those portfolios then can be mapped onto this graph where the horizontal axis is the standard deviation of returns over time, which is a representation of risk, essentially the variability of returns. And then the vertical axis is the expected return. You take each one of those portfolios and make a dot on the chart for this. And then once you've got all 44,108 on the chart, then you look at that total result. And what we get is pretty cool because this visual essentially looks exactly like what you'd see in a finance textbook when reading on information on efficient frontier theory. So that was a really cool and really exciting result for us, looking at it in the context of our products. And then the last key point is that the dark blue circles on kind of the top edge of that plot represent the portfolios that have the highest expected return at each level of risk. So for a given level of risk, the highest potential return is the portfolio that's on the top edge of that plot, and that So those dark blue dots represent the efficient frontier set of portfolios. Another useful way to look at this is to take that same plot that has the same 44,108 portfolios and identify the points that came from 100% allocations to individual index strategies within the product. And that's what each one here is labeled based on the index and then the length of the crediting term with the 1 and 2 year terms. And so the key thing that jumps out here is that no index by itself is on the efficient frontier, no strategy by itself. You do see some that are more towards the top right, but even those you can lower risk and achieve similar returns by diversifying. So really the key point here is that you need to diversify in order to have a portfolio that's on the efficient frontier. The other thing that I want to note is where the S&P 500 point-to-point cap strategy lands on this. That is the bottom left corner, the portfolio there. That strategy has the lowest standard deviation, which makes sense because it's a capped strategy and all the others are participation rate strategies. So its returns only fluctuate between 0 and the cap, but it also has the lowest expected return in conjunction with having the lowest risk. So this is all very useful and very interesting analysis, but as we were assembling it, we also knew that we needed to turn it into something practical to make it really powerful for thinking about allocation decisions within our products. So what we did was, based on that detailed analysis that I just walked through, we developed 3 sample allocations that are on that efficient frontier curve, essentially. So I'll talk a little bit about how each one is constructed. So the conservative allocation is all 1-year strategies. So that's an important note. 1-year strategies are going to have less standard deviation because they reset every year. And then there's also a significant allocation to the S&P point-to-point cap strategy at 40%. When you move to the moderate allocation, you introduce a 2-year component for the BNP multi-asset index. And then you no longer have any allocation to the traditional S&P 500 cap strategy. And then when you move to the aggressive allocation, you've got all 2-year strategies and all in the custom indices, with 60% of the exposure being the more equity-focused indices, the AI-powered U.S. equity index and the NASDAQ FC index. So these 3 sample allocations are not meant to be one-size-fits-all by any means, but we hope that they provide a helpful reference point when thinking about how a given customer wants to use our products. And then on the next slide, I just have one more lens that we can look through to show the benefits of diversification. So here we compare a traditional FIA strategy of 100% allocation to an S&P point-to-point cap strategy with those 3 sample allocation portfolios that we developed. So you see in all 3 cases that the diversified portfolios have higher expected annual returns. And that's just another way to illustrate the idea of being able to move up the curve, so to speak, on those prior efficient frontier graphs by diversifying. I alluded to this previously, but wanted to talk a little bit about the marketing collateral that we have to support these concepts. So the first 2 here, we've got content that just provides more information on the indices themselves and how they're built. We've got standalone brochures and fact sheets, and then we've got a guide that summarizes the index lineup all in one place. And then we've got 2 pieces that really show this diversification content at work. The first one is a sales concept that's a little bit more summary level and just points to the benefits of diversification. And then the efficient frontier report goes through the detailed analysis that I talked through today of how those sample portfolios are created and how those efficient frontier graphs were developed in the methodology that we use. So that's there for those that want to explore it in that level of detail. So just a few concluding thoughts before I flip over to the questions and try to answer some of those. We really hope that through today's session, we've increased your understanding of FIA products and how they can deliver value to our customers through both the combination of a thoughtfully constructed index lineup that provides meaningful choices to our customers and adds value relative to traditional FIA designs, and the power of diversification in leveraging that index lineup to position a product to deliver, to help deliver strong outcomes for customers over time. So again, really appreciate you joining us today. I will open up the Q&A now and try to hit as many of the questions as I can here. So just give me a moment. All right, there's a few that I'll start with those that relate to the kind of pricing fundamentals concept at the beginning. So the first one is just related to the option budget. So that in that example, that 3% option budget, that's the option budget that we manage to at issue and when we're managing renewal rates. So we determine that 3% option budget based on the economic environment at the time that we're selling policies and the asset yield that we can earn, and then we manage to that 3% option budget in the future, which the implication of that is that if option costs move around, then that can cause renewal rates to change, but we are managing to that same option budget, which also means that we're managing to the same profitability expectation that we had when we originally sold policies. And there's a few about the hedging examples on how we set up those call options. So one is in the capped example where we had an at the money and an out of the money option. Question is the expiration date the same or the maturity date the same? And it is. The maturity dates of these options are tied to the length of the crediting term within the product. So we buy 1-year options to back 1-year strategies, and we buy 2-year options to back 2-year strategies, and so on and so forth. So again, that's because what we want these options to do is exactly match the mechanics of the index credits when they mature. And we did talk a little bit about volatility. So generally speaking, volatility does have an impact here. It has more of an impact on options on just traditional indices like the S&P 500, where the alternative indices that have a volatility control mechanism built into them, the index itself is adjusting its exposure to risky assets based on the level of volatility. And that has an impact on how the index performs, but it also stabilizes option costs because then the bank that is selling the options to the insurance company doesn't have as much risk associated with how volatility can change after they have sold those options. All right, I think that is covering most of the things from, I'm just paging through, making sure I see all the questions that came through. There are a couple related to the diversification and efficient frontier concepts. So one is related to the relationship between standard deviation and expected returns. So generally speaking, higher standard deviation will is an indication of higher risk and more variability, which will also generally correspond to higher expected returns. So again, it's really that fundamental principle of risk return trade-off that you likely think about commonly working with your clients. It's at work very directly within index annuities, and we saw that across that kind of efficient frontier curve in terms of the standard deviation can be thought of as a measure of the level of risk that a customer is is comfortable with, and then identifying the portfolio that produces the highest expected return for that given level of risk is what the efficient frontier math and analysis is really all about. Right. I think there are a couple that just a couple came through. I do want to hit on this is the relationship between the length of the crediting strategy term and the caps or participation rates that you offer. So I mentioned this in talking about those sample portfolios, but generally speaking, the longer the crediting term, the more variability there is, and in particular, the less protection there is from the reset of the 0% floor. So longer term strategies are generally going to have a little bit more risk in terms of the variability of outcomes, but because of that, you can also offer higher growth potential. So within the product that we looked at here for this analysis, you see it in the 1 and 2 year strategies. We also have one product that offers even longer dated strategies of up to 7 years, and really the key reason for offering that was that when you as you extend that crediting term, then you can offer more and more growth potential while still preserving a 0% floor at kind of a global level when you think about over the life of the policy. But if you move away from resetting that 0% floor every year, then you can have more growth potential, and we think that just again further increases the flexibility of how the products can be put to work for individual customers. All right, I think that we've hit on the major themes in the questions that came through. So again, really appreciate everyone's interest. There were several questions about if the session is recorded, and as Julie mentioned at the beginning, the session is recorded and a link will be sent out afterwards. And thank you all for joining us. Thanks for your interest in the topic and your questions, and enjoy the rest of your day.